Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates, and 10-year note yields touched their highest level in over 4 years, getting north of 3%, but really unable to sustain that trade. It's not like we're failing anymore. The selling may still persist here, but ultimately we saw a big run in yields up above 3%. An expected trade, by the way, something that didn't come out of left field. It was very talked about trade even going back to the end of last year. And I think that as we got to 3%, we started to lose some of our momentum, and now you're kind of in that wait and see game. And the fact that we did see a drop back below 3% to end the week suggests that maybe we're not ready for this next phase, this next move in yields, whether it be because the economic data is a little bit squishy, whether it be because of the risks that are rising, whether it be out of the Middle East, the Iran nuke deal, something else that we're not pricing in. Likewise, the Fed, which wants to continue to raise rates, has yet to really echo a hawkish, overly hawkish tone that things are going to move faster than maybe the market has predicted. So I think ultimately we're going to have kind of a wait and see mode. We probably don't have to wait that long, though, given all the data we have next week. And volatility has been trending a little bit higher, which is something, again, is we're always happy to see that. We see higher vols, it gives us more price action. Expectations start to get a little bit wider, but ultimately we saw vols kind of trending a little bit lower this week after a substantial move higher over the last few weeks, and things are just kind of starting to look like, shrugging your shoulders, not much happening here. Although it's very odd because next week we have employment, next week we have FOMC and a slew of other data, and I think that all that comes together in this post-GDP week. You'd think volatility would be a little bit higher, but since we reached expectations specifically, any move now would be sort of away from expectations, away from 3%, and that in itself would bid volatility, but not to be. And lastly, let's talk about FOMC. It is a serial meeting, obviously no press conference, there'll be no question and answers, there'll be no forward guidance, it'll basically be a statement. And at these serial meetings, sometimes they can change a word or they can change a phrase or maybe add a sentence, and it gives the market something to think about. That's kind of under the old Fed and how they used to do things, and then we kind of get a little interpretation 3 weeks later at the minutes. I'm not so certain that the Fed wants to change anything, but maybe they want to make clear how they're feeling about economic growth with only modest GDP numbers today, as well as declining spending. And maybe they want to talk about inflation levels with oil kind of trading where it is, and maybe how they're going to redefine their 2% target, or maybe something along those lines to give the market something to think about. So I do believe the Fed wants to stay on course, gradually raising rates, possibly raising twice, maybe 3 times more this year. That would be their goal. But right now they are getting a little bit of resistance from not only from the data, but also from the flows. And I think that right now, this week's Fed or next week's FOMC meeting just could give us a little tip of the hat as to where the Fed stands as we head into the June meeting, which will be the big meeting where rates are expected to rise 25 basis points, and there will be a press conference and so forth, and that will be a lot more detailed. And certainly that is something that the market will focus on. But next week, it's all about May FOMC and April employment, two things that will give the market a little bit of momentum to either go north of 3% more, or more likely, I think, is what we're seeing, odds being priced in are from back towards 290. This is Todd Colvin coming to you from the floor of the CME Group.